welcome everybody to today's webinar. Let me just very quickly run through a bit of background information on myself, and I'll ask Malcolm to do likewise. Currently, I'm the program leader for the MSc Real Estate program at UCEM. Prior to being a full-time academic at UCM, I worked in industry for about 17 years. Specialisms, investment, office agency, retail asset management, valuation. I am on LinkedIn for anybody who might like to connect with me afterwards. Do look up, you'll see some further information on my background. As Sonia has mentioned, the RICS are actively looking at DCF at the moment. I'm very much involved with both the Royal Institution of Chartered Surveyors and also its sister body over in Dublin, in the Republic of Ireland, the Society of Chartered Surveyors Ireland. I am currently on the governing council for the RICS. That's the highest board within RICS, something I'm very honoured to be part of. I'm what's known as a geographical seat holder, representing the UK and Ireland. Recently, I've gotten involved in some teaching work over in Paris, something I'll be doing next month for ESPI, a French institution. So looking forward to that. And I'm also that poacher turned gamekeeper. I was originally a student for UCM while I was based in Dublin. I did a master's in property investment at the time. So I can sympathise with my students, the challenges they go through. I'm also currently an APC chair for the RICS and SCSI, and then just finally I'm what's known as an Inspire Ambassador, where I go out to universities. I was out in Reading University a couple of weeks ago and met some lovely students there, just to hopefully give them some further insights into what it's like to get involved in the built environment and developing a career in surveying. I also go out to secondary schools. It's something I love to do as well. That's me. Let me just pass over to Malcolm. Malcolm, would you mind just giving us a rundown on your profile?
Yeah, morning everyone. Yeah, my background's very different. So I spent a lot of time at a company called IPD, and we basically created empirical series for what actually happens to real estate returns. So we're going to be talking about cash flows. So very much when I was there, it was all about documenting what the cash flows had been. I then moved into the industry, and my job there was to basically project forward cash flows and returns. I then set up a company called Real Estate Strategies, which I still run. And I think here we are projecting forward returns. We do forecasts, but we also spend a lot of time talking to investors about their investment process and how these sort of techniques should be used to make investment decisions.
Great, thank you very much. So in terms of using the working title here today, making them mainstream DCFs, it's worth maybe just taking a moment to look at. In a later slide, I'll look at some background as to where DCF came from originally, but more recent history. In December 2021, there was a report produced by the RICS, the Independent Review of Real Estate Investment Valuations, led by Peter Pereira Gray, to basically look at the practices out in the marketplace. This was an 81-page document, so quite an extensive piece. The review, interesting, I've highlighted in red here, the review called for a much more analytical profession, which is an interesting point we'll consider in further detail. And it also makes the point, one that uses DCF as the principal approach to valuation. So I do know that there is a report due out, an update, a follow-on piece in the next month or so from the RICS in that regard. There is a debate about that whole notion that DCF should be the principal approach. And what do we mean by DCF in that context? So that's one to maybe think about. In April 2022, the RSS established a subcommittee known as VRIC, Valuation Review Implementation Committee, to implement the recommendations of the Pereira report. March 23, the subcommittee carried out further consultations, And the purpose of the consultation on UK valuation practice was to essentially ensure market confidence and trust in the use of the investment method of property valuation, to support the new standard for valuing investment using DCF. RICS proposes developing a transition hub for upskilling chartered surveyors globally, with a particular focus on territories where DCF is currently underutilized. So interesting developments happening at RICS in that regard. According to VIRIC's valuation review implementation roadmap, changes to the Red Book and an updated standard on discounted cash flow will be published in 2024 in the first quarter. So it's one to look out for, particularly in the context of the Red Book, which is so central to valuations undertaken by surveyors globally. I mentioned there was reference there to SRB, the Standards Regulation Board. That is a very important independent regulatory board within RICS. It then in turn reports to the Governing Council, which I'm on. So I really look forward to seeing the updates that are due out shortly in regard to DCF. Malcolm, had you any particular thoughts in terms of any points raised here?
Well, only to say that, I mean, this background starts in December 2021, but I think the first report was even before even I joined the industry, in
true.
1992. So
it goes back.
A long
Indeed. So thank you. Malcolm, if I could hand over to you to take us through this slide.
Yeah, so what we've got here is, I'll just talk through the actual slide there, the chart. And just to illustrate why this is a sort of issue, and also it's a very current issue. But the time period I'm going to look at is not the current time period. I'm going to focus first on the period just before the global financial crisis. So in basically mid-2007. Now you can see the shaded area there has basically fallen all the way down to the axis. It's fallen all the way down to zero. Now the shaded area is measuring the gap between the bond yield, and we've taken a 10-year gilt yield as our bond yield. That's our proxy for our risk-free. And it's taken the gap between that and what we've called an equivalent yield. So we can basically say that's what the valuer's pricing yield was at the time. So you can see there is no gap. Now, the reason why that's interesting is, of course, not technically, you should require a risk premium from property. So you could look at the fact that there is no gap and basically conclude that real estate is completely overpriced. That becomes quite interesting by what you see happening next, when the equivalent yield or the pricing of property shot up. So the capital values fell. We did go through the global financial crisis, and that was the reason. So you could say, well, surely in 2006, 2007, the valuers should have been saying to their clients, look, here's your valuation. However, if we do a DCF explicit calculation, we basically conclude that you are basically getting no risk premium whatsoever. So we would conclude that real estate is overpriced. I've really simplified that. We could have made that far more complex. Take it forward to today, and you can see something else is happening. You can see that the gilt yield is going up. It did actually go down yesterday, hooray, but it's been going up. I'm sure everybody's noticed. And that has had an impact on the equivalent yield. That's been going up, so prices have been going down. So you could argue that today, the valuers should be using this information to talk to their clients and say, look, if we construct a DCF worth calculation, we can basically show you what should be happening to prices, and prices should be falling further. That's not, I'm making a conjecture there. You could argue with me that prices should not be falling further, and they're absolutely correct. But you could make the argument that really the equivalent yield should be higher, and prices should be lower. So we've used this graphic really to illustrate the point that if you do something very simple, like the traditional UK valuation, as sort of proxied by that equivalent yield, you can make very sort of you can make statements about the level of the valuations by doing a worth calculation as well. And we've done a very simple one there, just a simple comparison, but a full DCF would be much more detailed.
Great, thank you, Malcolm. So it's worth maybe at this point just considering an investment method. What is meant by that? There is the traditional approach of using the term reversion or hardcore methods, and then there is the discounted cash flow method as well. The DCF method is a form of valuation that calculates an investment's value based on the ability to receive a predicted future cash flow. We also should, at this point, consider price, value, and worth. What is the basis of the appraisal? Investment value is not market value, not red book valuation. Investment value, the value of an asset to an individual investor, perhaps, rather than the wider market. What is it worth to them and their particular requirements in regard to risk and return? Then market value, for any surveyors here, they'll readily recognize the definition here, the estimated amount for which an asset or liability should exchange on the valuation date between a willing buyer and a willing seller at arm's length, after proper marketing and where parties had each acted knowledgeably, prudently, and without compulsion. So that is more the wider view on the from the market in terms of, and that is the basis on which many red book valuations are undertaken. Looking at the history of discounted cash flow, you can go way back, but I guess if we start from the stock market crash in 1929, Irving Fisher, in his book in 1930, The Theory of Interest, and John Burr Williams in 1938, his piece on the theory of investment value, first formally expressed the DCF method in modern economic terms. More recently, it's been observed that in real estate terms, the measurement, benchmarking, forecasting, and quantitative management techniques have evolved. Interestingly, and it's Malcolm, you and I were both at the presentation that was given back in 2017 by Colin Lazari and Nick Mansley from Cambridge, where they did equally form the view that in the real estate sector, it hasn't been adopted into standard practice. The capital budgeting techniques that are commonly used in other investment sectors, and I'm thinking more particularly in the US, the equities markets, their research, I was really quite surprised. I guess maybe I wasn't aware of general practices in the use of DCF in the market at the time, but the report flagged that it is common practice in the UK to use non-cash flow decision-making tools such as payback and profit on cost in the investment process. There is significant evidence of discretionary behavior being exhibited by investors in the measurement process, and which is leading to inconsistencies in the use of key metrics in the decision process. And there's a reluctance to adopt more sophisticated quantitative-based applications in the use of DCF. So it feels like the market still has a long way to come in terms of accepting DCF, the explicit form of it, let's say, in real estate. So had you any particular thoughts yourself, Malcolm, on that slide before I leave it?
Well, I think it's worth making the point that a valuer is paid to give you a value. That's what they're doing. Everything else is a byproduct. So yes, they do give you a yield, and yields are discussed in the market. And there are various forms of yields, initial yields, equivalent yields, etc. The value is not paid, unless you do pay them, to do that calculation using an explicit approach. But it's basically being suggested that if you do say to the valuation industry, if you use a more explicit approach, then we can actually take the pieces of information that you give us and then think about them. So we can see what growth assumption you put in there. We can see what risk premium you put in there. We can see what cost assumption you put in there. We can see what vacancy assumption you put in there. So the valuer would be handing over more pieces of information. So that would be my thought. The valuer fundamentally, though, is paid to give you a value. They're not paid to give you all these other pieces of information. But it might be useful in the industry if the valuers did, and then we would get all these other pieces of information. Mm-hmm. So that's what all these consultations are about. It's like, well, if we ask the valuers to do it this way, we know we'd get something more useful. But are there some issues with that?
Yeah. So really interesting. Thank you for that. Sonia's just put up a posting encouraging people to use the chat box. Jump in if you have any questions you wish to add. Very happy to look at them as we're going through the slides. We're nearly finished actually with the slides, and we'll move to the Q&A session shortly. But just finally, in terms of challenges facing the marketplace, I've just my own thoughts here, pulled together the 5 based on Colin and Nick's report as well. But fear of change, there's a traditional approach that is adopted, and it's a method that is firmly embedded within the Red Book. Inconsistency of use, many valuers are unfamiliar with the DCF model. It's interesting, I did a similar sort of webinar back in June in Dublin, and there was huge interest in wanting to know more about the DCF model in that market as well. So we can see that there's an unfamiliarity, but a keen interest to know more, because they know that clients are using it. Lack of transparency on risk. The traditional methods apply implicit adjustments regarding risk, which is problematic for investors who are used to more transparent adjustments, and particularly perhaps investors who are coming from a different world of investment, particularly equities. Risk in context of property can be defined as either specific or systematic. The drive, I make an interesting point here, the drive to net zero carbon in highlighting specific risk in the form of obsolescence in buildings, while systematic risk is currently very evident in the form of volatility in the local markets and global economies. Geopolitical risk also impacts on the valuation as a form of systematic risk. The value DCF model can more explicitly address these various forms of risk. Interesting though, they can express it, but it gets into a degree of subjectivity, but it does encourage greater transparency. Point 4, future rental growth not factored in. The DCF model of appraisal or valuation differs from the traditional methods as it adopts market assessments of future growth in an explicit way. This future income stream is then discounted back using the hurdle rate to establish value. The traditional methods only use today's rental values and discounts the income at a rate based on analysis of comparable transactions. So there are differences there. Analytic tools are too basic. The stress testing techniques are limited in terms of how they're used by many investors. Scenarios used, but other forms of risk such as sensitivity and probability analysis need to be more widely adopted. So there are various challenges. So interesting times really in the marketplace in terms of how valuers should approach the use of DCF and the stress testing techniques that come with them. Had you any final thoughts, Malcolm, before we open it out to the floor?
Yeah, I mean, I think the sort of overarching issue about the valuation is it's a really difficult place to move from. So you're given a valuation. If you want to then roll that forward in time, that's very difficult to do for various reasons. If you're given a valuation for one property, it's actually very hard to apply that valuation to another property. So it works really, really well when you've got two really similar properties side by side, one gets sold, you can basically say, right, I can basically use that comparable of that price and I can apply that to the property next door. Works really, really well. But it really does start to fall down when you get more differences. So you highlighted one there on net zero. So if you've got one building where you think there's going to be £1 million of capex required, got the building next door, you've got £1.5 million capex required, you really should be saying, look, there's £500,000 difference, so it's got a £500,000 lower valuation. If that's put into a DCF count, explicit DCF, then you can roll that forward and say, well, once they've spent that money, that's obviously in the past. So it becomes a much easier thing for people to use. I mean, many people who use valuations, they'll get the valuation, they might get the Argus file, but you can't start with a valuation and just use that and then project forward your IRRs. You've actually got to start with your valuation, and then you basically got to start again. You've got to build a DCF because you've got to make explicit assumptions. So it's a really, it's a starting point that isn't very helpful for anything. It's very hard to apply to other things. It's simple questions like, the bond yield's just gone up 50 basis points. How does that fit in? Well, you don't know because the valuer's not told you. What's the growth rate? How's that changed? Well, we don't know. That the valuer's not told you. So there's so little information that you get that if you had a more explicit valuation, it would be nicer.
Okay, thank you, Malcolm. I have a couple of questions that have come in, and thank you for the questions. I'm not sure whether the second one is from somebody I can see who's based in the UK. The first one, I'm not sure where they're based, but they just observe, I'd like to inquire about a long-standing issue we face, identifying factors like discount rates that are not easily accessible in the market. Could you recommend a platform that might aid in this? Have you any thoughts on that, Malcolm?
Well, I mean, this takes us right back to what is the discount rate in the market. So if you're doing an investment worth calculation, then you will be working out what your capex requirement are, what your growth assumption is. In a valuation, in a traditional valuation where it's implicit, you're not. So when you see a market transaction, you've got a bit of a problem, because the person the organization that bought the asset, they will have done their own DCF appraisal to decide what they would pay for the asset. So they would have done all that work. When they did that, they will have worked out their discount rate. Now, it's always very interesting when people say discount rate, because in theory, in the textbooks, it's their weighted average cost of capital. However, in the real estate industry, if you ask most organizations, what's your weighted average cost of capital? It's not something they think about in those terms. The exception there is if you're a listed property company, because a listed property company knows what its weighted average cost of capital is, because they know what their cost of debt is, they know what their share price, they can actually work it out. Interestingly, in real estate, we do something quite strange. We actually go out and we market real estate with labels. And the labels typically are core plus, value add, opportunistic. And if you look at the definition of those labels, they have a return next to them. So they have a return. They don't have a risk label. They have a return label. However, you can therefore say, right, well, if I've got a core investment which is requiring a 7% return, then I am telling the client I'm giving them a 7% return. Therefore, my discount rate is 7%, full stop, because I've sold the property on that basis to my investors. Therefore, that is my discount rate. But for a valuer, they can't do that. It's just not possible. They cannot do it. They can't see, you know, if David was bidding for the property and Sonia was bidding for the property and David won, the valuer can't see that. They can't see all the workings out. So they can't do that. All they can see is the price, and then they know the basics of the property. So all they can do is they can solve for that all risk equivalent yield. What would be good is if there was lots and lots of other evidence out there in the market on, you know, what are growth expectations? What are people's discount rates? What are CapEx rates? So that would be a mixture of empirical data, how much they've been, and also forward-looking data. So that might be survey data of expectations, but it might also be when investors have undertaken analysis of their properties, basically surveys, to work out what the required CapEx is. That would be really useful information to be out there in the market.
Great, thank you, Malcolm. I'm mindful of time, and apologies if I'm cutting across you, but one further question, and this question could keep us for another 10 minutes, so we may not be able to answer it fully, but let's have a go before I hand back to Sonia. I understand the use of DCF for investment worth, but for evaluation, where does the market evidence come from for discount rate, growth, exit yield, CapEx, etc. required in a DCF?
I was trying to answer both questions at the same time.
Yeah.
So I sort of merged them both together. So I was trying to answer both. So I was sort of trying to put them both in. A valuer can't. They just can't do it.
Mm-hmm.
Now, if you are doing a worth calculation, you're doing DCF, then there are lots and lots of different techniques that you can use. Now, there's a second question come in, which I'm just reading here.
Mm-hmm.
This is interesting because what the question is basically saying is that there's a corporate weighted average cost of capital. Yep, correct. Then we've got this issue about, do you adjust individual properties for property specific risk? Now, this is a really interesting question because in the finance textbooks, they will tell you in equities, you do not adjust for individual property risk. You use basically CAPM and you work out risk and return like that. All of the idiosyncratic risks, they're all diversified away in your portfolio. So you imagine you've got one, I don't know, logistics unit in Reading. Mm-hmm. That's really risky on its own. If I own 100 logistics units all around the southeast, the risk of that portfolio will be the risk of logistics units in the southeast. The fact that some of them did well and some of them did badly is irrelevant. It's been diversified in a portfolio. Mm-hmm. So the risk is actually the risk of logistics units in the southeast. And then you get questions like, well, is it industrials? Is it logistics? Is it the southeast? Is it the rest of the UK? And that's a sort of, you know, quantitative question. The counter argument to that is, how many investors can buy 100 logistics units? Well, prologists, maybe.
Yeah.
So actually, a lot of investors are likely to have some residual risk. Now, that is a really interesting question. There's no obvious answer to it. But technically, the textbooks will tell you idiosyncratic risk, property-specific risk, you don't get rewarded to it, so it's not in the price. Market risk is in the price. The risk of rental values in the market going up and down and yields in the market going up and down. If you've got an individual lease with a lease expiry in 2025 or something, the fact that you may get one return or another return, that is diversified away, because if you had 100 such leases with the same lease expiry date, you would basically get the average. So if there's a 50% chance of one and a 50% chance of other, then you will basically get the average. That's what you'll get. So that risk between 50 of them getting a renewal and 50 of them getting a vacant, that's just noise. You don't get rewarded for that.
Yeah. Thank you for the question being asked, and thank you, Malcolm, for your reply there. Very, very interesting.